All right, let's jump right in. We're going to tackle a piece of business wisdom that feels, as solid as gravity. Good corporate governance is always good for a company. But what if it isn't? We're going to dive into a pretty fascinating study that turns this fundamental rule completely on its head.
For decades, the mantra has been crystal clear. If you implement transparent rules and protect your shareholders, your company's value is going to grow. I mean, it seems like a total no-brainer, right? But this whole explainer is built around one really powerful question. Can a company be too well-behaved for its own good?
Okay, so first things first. What exactly is corporate governance? Well, in simple terms, it's the whole system of rules and practices a company uses to run itself. And the main goal? It's really just to make sure that investors, the people putting up the cash, actually get a decent return on their money. And this quote pretty much sums up the conventional wisdom. The idea is that having better rules makes you more investor-friendly, and that trust leads to cheaper capital, which, let's be honest, is a huge competitive advantage for any company. So the theory seems super straightforward, but a couple of researchers, Ann Anderson and Parveen Gupta, decided to really put it to the test. They took a look at this massive data set. We're talking over 1,700 companies spread across 22 different countries. And what they found suggests that this simple theory, well, it just doesn't work everywhere. The reality, it turns out, really depends on where a company calls home. And that's because companies don't operate in a vacuum. The study identified two really critical factors in a country's environment that just completely changed the game for corporate governance. Let's break those down. First up, how do companies get their money? In market-based systems, like you see in the US and the UK, the funding comes from these huge public markets, stocks and bonds. Information has to be public, it has to be transparent for millions of different investors. But then you've got bank-based systems, like in Germany and Japan. There, powerful banks are the main source of cash, and these banks have really deep relationships with companies, and they can get inside info that the public just never sees. Okay, the second factor is the legal system. And you can kind of think of it like a game. In common law countries, the referee has the flexibility to interpret the spirit of the rules. But in civil law countries, that referee has a super thick rule book and has to follow the letter of the law with basically no room for interpretation. Now, this is where it gets really, really interesting. When you combine these two things, the financial system and the legal system, you don't just get two kinds of countries. Nope, you actually get four very distinct economic worlds. And this matrix lays out those four worlds perfectly. So on one diagonal, you've got what the researchers call aligned systems. In the top left corner, places like the UK have public markets that fit really well with their flexible common law. Then, bottom right, Germany's powerful banks line up perfectly with its strict civil law. But on that other diagonal, you've got these misaligned systems where the pieces just don't fit together so neatly. It creates a much trickier environment to operate in. So, with this whole framework in place, the researchers started looking for that link between good governance and company value. And you know what? What they found was completely unexpected. I mean, the logical assumption, the one everyone had, was that good governance, more transparency, better rules, would be a universal positive. It should add value to a company, no matter where it is. But the data? It told a very, very different story. Let's start with that first aligned system, the market-based common law countries. So we're thinking of places like Australia, the UK, and Canada. Here you've got public markets that are hungry for information, and you've got flexible courts that can actually enforce nuanced rules. And in this environment, good governance pays off, big time. For just a standard improvement in a company's governance score, the study found almost a 4% increase in its market value. This is exactly what the traditional theory predicts. It works like a charm here. But now, let's flip over to the other aligned system. We're talking about countries like Germany and Japan with those powerful banks and really rigid code-based legal systems. And this is the shocking part. In these countries, making the exact same improvements to corporate governance didn't just have zero effect, it actively destroyed value. A standard improvement led to an almost 3% drop in the company's valuation. So what on earth is going on? Well, to explain this totally bizarre result, the researchers came up with a new idea, and they called it the alignment theory. And honestly, it's incredibly insightful. The theory is actually pretty simple. Good governance isn't some universal checklist you can just tick off. It's all about creating a system that is the right fit for your specific environment. Value is only created when a company's internal rules are in sync with its country's external, financial, and legal worlds.
So why does good governance
totally backfire in a place like Germany? Well, there are two big reasons. First, it's redundant. Those powerful banks are already acting as super strict watchdogs with inside access, so adding more rules is kind of like hiring a second security guard just to watch the first one. And second, it's unenforceable. Remember that rigid legal system? It's not designed to interpret the spirit of these new rules, only the black and white letter of the law.
So here's the crucial point. When a company in this kind of environment spends a ton of money on so-called best practice governance, it's just a bad investment. They are spending real money on systems that are both redundant and unenforceable. So investors look at this, and they don't see good management. They see a waste of resources. And as a result, the company's value actually falls.
And this brings us to the big takeaway from all of this. What the study really shows is that when it comes to corporate governance, there is no one-size-fits-all solution. Context is king.
The implications here are huge. For managers, it means you can't just copy and paste a governance model you saw work in another country. For investors, it means a high governance score isn't automatically a good thing. You have to ask if it's the right kind of governance for that specific country. And for regulators, it's a big warning against forcing these global best practices on everyone, because they might actually do more harm than good.
Ultimately, this research forces us to reframe the entire conversation. It really suggests that the most important question for any global company isn't simply, are we following the best rules, but instead, have we designed the rules that are best for where we actually are? It's a subtle change, but it's a really profound shift in thinking.